Hey guys, this is Brandon, your trusted realtor, and we're here to help make the dream of owning a home a reality for you, one step at a time. So today we're talking about a super important question. How much house can you afford? Now, oftentimes first-time homebuyers or homebuyers in general struggle with this question. Now, when you're dreaming about your perfect home, whether it's a cozy cottage or a big sprawling mansion, there's one big thing you need to think about: what a lender, basically a bank giving you the money, looks at to decide how much money they'll let you borrow. So we'll dive into that with even more detail. First, imagine you're buying the coolest, latest video game console, but you need to borrow money from your parents. Before they hand over the cash, they'll think about a few things, right? Like, do you have enough allowance saved up? Or are you already borrowing money for something else? Banks think the same way about giving you money for a house. One of the biggest things they look for is a thing called your debt to income ratio. This might sound complicated, but it's actually pretty simple. It's a way for a bank to see how much money you owe compared to how much money you actually make. Now, let's break this down in a little bit more detail and use some examples that may help you picture it. Imagine this. You make $100 a month from your allowance and doing odd jobs, but you also spend $20 a month on a comic book subscription. That's your debt. Now, to find out your DTI, you divide your debt of $20 by your income of $100. So 20 divided by 100 equals 0.2, or when you turn that into a percentage, 20%. That means that 20% of your income goes to paying off your comic book debt. Now, lenders usually like to see a DTI of 36% or less, including your future mortgage payment and any association fees. If you spend too much on your mortgage, then you won't have enough left for things like fixing a leaky roof or buying groceries. But it's not just about the debts and the incomes. Lenders also are looking at your credit score. It's kind of like a report card of how well you've been handling your money, how stable your job is, and how much money you have saved up for the down payment. The more you have for the down payment, the less you have to borrow, and the easier it is to afford your dream home. Now, remember that just because a bank says you can borrow a certain amount doesn't mean that you should borrow that much money. You can and you need to think about other expenses like taxes, insurance, and making your home feel like a home. So let's go ahead and wrap this up for today. If you found this information and this explanation to be helpful, go ahead and give me a thumbs up. And don't forget to subscribe for even more home buying tips. Remember to keep dreaming big, but plan smartly so you can turn your dream of home ownership into a reality. Take care.